You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Hello. Welcome back to another episode of The Builder's Mindset. And guess what time it is? Yes, I've been talking about it. It is earnings season yet again. One of my favorite times of year. It comes 4 times a year and I just enjoy it. So I'm going to give you a little sneak preview in today's episode as to what's coming out and should be available on Monday. If you're interested in getting your copy of the market highlights, including a builder by builder, the good, the not so good, and the notables for each of the public home builders in the United States, as well as my market highlight and assessment and the summary snapshot of all of those builders' metrics, including the ones they talk about, they report on, and then some of my favorite, as most of you know, and I'll reiterate again, I love absorption pace, I love cycle time, I love cancellation rate. Those are some of my favorites, and then as well, their profits and margins and percents and all that good stuff. So that will be available most likely on Monday. Please keep an eye out for that. There'll be a sign up link to get a copy of it, and it will include Q2s as well as Q3s. For most builders, right, Q2, Q3. Some of the builders are finishing up their year right now. Beazer and Horton have wrapped up their year end, and others are finishing up Q3. So let's dive right in real quick, and just kind of as a step back a little bit. So Lenar is a month ahead, right, of everybody else because of when their fiscal year ends. And so I did mention to that, one of the notable things from Lenar's report was their cost reduction of direct construction costs. That's vertical for those of you. So the cost that it takes for them to go from a finished lot, so foundation up through the roof and everything in between, they had a reduction in those costs annually of 6%. In the same quarter for Meritage, they reported 4%. And then if you'll remember from last earnings report that Horton had reported, I believe it was 9% year over year for their previous quarter. So their cost savings, if we look at Lenar's, 9% reported in the previous quarter, year over year, 6% this would say that their cost savings are slowing. And that makes sense to me because, and we'll talk about in a little bit some of the problems with the housing market as it relates to why we're having persistently high costs and why there are headwinds to the industry. And so they're, in my opinion, going to start to see a tapering off of those savings as we go forward each quarter, as they look at it year over year, because I think they're getting to the margin of diminishing returns. They have phenomenal scale, as do a lot of their competitors. There's only so many public home builders. They're all very large in their scale. But at some point in time, the cost can only go down so low. So I think we're seeing some slowing in that. 6% they reported. Meritage reported 4% year over year. And as I mentioned in a post not too long ago, but John Burns in their 2025 economic outlook, when they did their survey, he had reported that their survey had said on average, builders are reporting a 3% increase year over year in their cost, which in my opinion is really more indicative of what's going on for the vast majority of home builders. Okay. If we get outside of the public world, we get outside of the top, let's call it 50, 100 builders, probably even outside of the top 25, builders are continuing to see their costs increase, albeit maybe at a slower pace. And so, with that said, I am optimistic still. I'm bullish on home building. I think it drives the economy, creates tons and tons of jobs. But there are a lot of headwinds. There really are. And, some of the headwinds are the big things that impact the overall cost of a home. And then on top of that, we put the persistent high interest rates. Let's start with interest rates first. When you get the report, take a look at it. I always talk about absorption rates. So in my opinion, the number 3 is really the threshold. Ideally, for a production home builder, you want to be selling one home per community per week, closing one home per community per week, to really be driving efficiency in the whole model. That would be 4.33 because, as we know, the only month that actually has 4 weeks is February. Every other one is 4.33. But 3 for me is kind of the sort of the salt line. If you're above 3, you're in the good territory. If you're below 3, that doesn't exactly mean you're in the bad territory, but what I would say is if you're below 3, you need to be really holding some margins that are better than others. So that means you got to be getting that number, that lower number, because your price is higher and you're choosing to play on the margin game and make slower dollars versus faster quarters. And so, but for me, it's 3 is kind of the salt line. If you're below 3, I think you're aspiring to be at 3 or above 3, and you can look in the report to see who falls in that category. And if you're above 4, really, really good. And if you're above 5, like just forget it. It's off the charts. That's just phenomenal. Go ahead and take a quick look at the summary when it comes out on Monday, and I'll just give you a little bit of a sneak peek. From an absorption perspective, Lenar reported 5.5 sales per community per week on average. There's a good number of the other builders are above the 4 threshold. We've got a fair number above the 3, and then there's your suspects who are below 2. And like I said, there's just because you're below 3 does not mean it's bad, but it really typically, in my opinion, needs to come with a higher sales pace and a higher margin. So that in and of itself, in my opinion, when you can see we're beyond the spring selling season, we're beyond the summer selling season, we're in that window of time this last quarter that for most of these builders has finished up September. So we're talking July, August, September. School's upon people, the slowdown, for sales. This is a slower time for sales. It's a cyclical business. It's a seasonal business. But for me, the number of builders that are still achieving 3+ sales per community per week on average nationally tells me and supports for me the fact that there is still strong inherent demand in the marketplace. You put that on top of persistently high interest rates, okay? Since October of 2022, we have had persistently high interest rates, but the bigger builders have been buying those rates down to, let's call it around the 5% mark, somewhere in that neighborhood, 4.75% to 5.25%. So that's where it's holding. And I've said this before, there's a lot of talk because of the election about interest rates. I firmly believe that we're not going to see actual interest rates for buyers of new homes lower than 5%. Again, if the interest rates drop, builders are already buying them down to about 5%. And in doing so, they've managed to find this kind of threading the needle where they're still able to get 3, 4, and in some instances, Lenar, 5+ sales per community per week. So unless interest rates fundamentally and in a net go below 5, I don't think we're going to see that. What it will do, though, if interest rates come down, to be quite honest, it will make the affordability index have a bigger impact on the resale market. And so that could put some competition and pressure on builders. So more on that, we'll just have to watch how things pan out. But I don't think actual interest rates, like typical 30-year fixed or FHA, start to get really much into the 5s in my opinion. That's my opinion, my prediction. We'll see if I'm right on that. My last prediction, Lenar stock price, I was wrong on that, but we won't delve into that. But so that's the piece on sales pace is still there with interest rates, really coming out at 5% for these home buyers due to incentives and builders paying, increasing their SG&A expenditure and others, to get that down to 5%. They're selling homes, right? They're all still getting, their sales pace is up year over year. Don't listen to any headlines right now that talk about new home sales being down. because if they're saying that, it's either month over month or it's it's probably month over month, and we're in that time where this is normal. So what you really want to look at is year over year. What were their sales this month compared to this month last year? And by all measures, they're up. And so the overall market assessment for me is that most builders have managed to continue to grow and improve their SG&A, their sales general administrative expenses, while and by increasing their number of closings per employee. They're getting more efficient, they're being more strategic, and they're continuing to grow, whether that's through acquisition or just increased sales pace at existing communities. And so they're leveraging that growth to lower essentially their kind of their overhead, their sales and general overhead expenses. And some have been able to improve their gross margins. Cycle times are definitely getting better too for most builders. And some are seeing a little bit of a challenge hitting their margin numbers. They're still typically higher year over year, but they're kind of struggling to hit the margins that they were forecasting because those persistently high interest rates, they are having to pay to buy those down with future commitments and other mechanisms that they're using. In the not so good aspect of things, incentives, as I mentioned, they're still being used considerably to drive that sales pace, which has been a bit of a drag on some of the builder margins. I'm not worried about it, but we talked about it. Wall Street is pounding the big builders when they report missing their expected or their forecasted margin by even as little as, 0.2%. And we've talked about that kind of the whole system, whether you believe it or not. I think there's some inherently not great things about it, but it's getting more challenging because builders are having to continue to do this. But if you look fundamentally, most home builders are performing really well by all metrics. They're just getting penalized on their stock price right now because they're missing their margin forecast by a little bit, or they're not growing their margin year over year, but they're still keeping their production pace, their sales pace. And so that's creating some challenges for them, and they're getting penalized, from a stock price perspective, but their margins are still really, really strong. And so maintaining community count has also been a challenge for builders because of the hurdles to get them open. And as we've talked about in the past, the kind of pause of land buying and land processing between October of 2022 and March of 2023, that 6-month window of time, we're kind of in that now for what would be new communities opening. We're seeing this like new bids events are slower right now from a vertical perspective. New community starts are a little bit slower, but I expect that that's going to change and will start to ramp up as we get deeper into the 2025 year. And it remains to be seen how much that might impact the selling season for spring this year in terms of not getting communities open in time. But that's what's impacting their community count. And go back to it. I said I'm a big advocate of absorption rates and sales per community per month. So if you're selling faster into communities and then you're not able to replace them as quickly or at the pace, it's going to get harder to maintain these numbers. Once again, the optimist, I will tell you, don't listen to the negative headlines. The inherent demand is still there. So fundamentally, supply demand. Let's just go back to basic microeconomics, Econ 101, supply and demand. So demand is inherently still there, and we're undersupplied. We'll talk about that in a second. So, the ever-increasing challenges and regulations and development have forced some builders to go deeper into these communities because you put the pause in buying in that window of time with other communities that they already had, maybe taking 3-6 months longer to get open because of approvals and regulations and all the government bureaucracy. I don't want to go political, and I don't think Elon Musk will solve all these problems with his Department of Governmental Efficiency or whatever it is he's going to do, because most of this comes down to the state and local levels, and we still have just a smattering of just bureaucratic idiocy when it comes to approving new land deals. I won't even go into the NIMBYism or all the other stuff, but just generally speaking, that's a problem. We'll talk about that in a little bit in terms of the supply and cost. So The notables, look, the notables are builder metrics are generally pretty strong. There's a couple you'll see, and there's a couple of builders that I question and I put in their notables or they're not so good as to, like, some builders seem to be a little bit more off in terms of higher cancellation rate than what I think they should be, lower sales pace than an absorption of what I think they should be. Some of them are struggling a little bit more with margins in this time than others. But generally, demand is strong, and the good operating builders are leveraging their scale and growing. And I'll make one other prediction here. I'm predicting two things for the most part: that we will not see the fundamental interest rate. Like, if you Google 30-year fixed mortgage rates and you look at it between basic, like, conventional and FHA. Typically, the Google will report the FHA in the search. I didn't do it today. I guess I could do it right now as I'm recording this, but I don't see those getting down below 5.5. Like, I'll just call that right now, and we'll see 30-year mortgage rates as of right now today. 30-year fixed 7.494. 30-year fixed FHA 6.74. Remember, I said that's another thing when you look at the headlines and they talk about rates. Make sure you're, like, figuring out which one that is. Not everybody qualifies for an FHA. Not every community also qualifies for an FHA. It's more red tape, more paperwork. It's more difficult. But so I don't see those, and to be quite honest, I don't really see those below 6%, but I'm not betting lunch on that. But I will bet lunch that we will not see them lower than 5.5. Anytime in the next 12 months for sure, probably 24 months and beyond. And I'll go so far. We will not see interest rates lower than 5% in I don't know when. So with that being said, back to demand and supply. Demand is inherently there. It's proof when you look at the sales pace. If we can get the interest rates down to 5% with incentives, it is there. The demand is there. There's a housing shortage. Okay, so supply demand. We're talking microeconomics, Econ 101. The demand is there. So what is the problem? The problem is supply. That, in my opinion, is the biggest problem. And we're not going to solve that supply problem, or should I say, we're not going to solve the pricing problem of housing without getting the supply up. I don't care. That's another prediction I'll make. Until we solve the supply issue, fundamentally, we are not going to see a significant reduction in housing affordability. Like, we're not going to see that come down, or should I say, get better. Housing affordability will not get better. And there's three main things, in my opinion, that keep driving to this. Is number one, it's rising land costs. And if you dig deep and you really want to go into the weeds of the home builder earnings reports and dig into it, what I'm seeing there is they're reporting stabilizing land and land development costs. Those are still actually on the rise, but not as much as they were a year ago. They're starting to stabilize from what I'm hearing. And then the big notable thing, we talked about Lenar reported their mill rows. They're going to spin off all their land assets and some cash into a publicly traded separate entity that is not run by Lenar. So that may help these rising land costs. I mean, that's kind of what they were talking about. And hopefully that creates a little bit more competitive marketplace for land and land development. But that's one of the things that's still, in my opinion, driving the problem with overall supply, because it's costing more, it's taking longer to perform those functions, to get that land to fruition, to available inventory. And then we've got a rising labor cost that I think is indicative of the capacity of the machine. Residential building worker wages, hourly wages in August of this year were up 10.8% per there was a study by the NAHB, and then in September they were up 9.9%. That's annualized. So, and think about this: the average the average hourly rate for a construction worker, non-supervisory production hourly rate employee, is $33.51 an hour. Without overtime, that's about $70,000 a year. So if you think about that, depending upon the market that you're in, The average new home costs 400, and I think it's up to $460-ish thousand dollars now. That's not really an exorbitant amount of money, in my opinion, for a skilled trade to make. But that's a problem in terms of getting the people into the workforce to help give us more capacity to build more homes. I've said before, 1.6 million annual starts a year is about where the system runs smooth. When we've gotten up to 1.8 in the past, decade, I've been there, I've lived it. The system starts to burst, and we start to see the cracks and the strains in the scheduling and the capacity and the quality. And so those rising labor costs, in my opinion, are also keeping the supply down because it's making it harder for deals to pencil. Put that with the rising land costs and the land development costs, deals are getting more and more difficult to pencil, and we continue then to exacerbate. And what I say, builders are reporting lower direct costs. So we're pushing down those costs, and if that's impacting labor, what we really need to do is we really need to entice more people into the skilled trades to be able to build the houses. And that's, in my opinion, a huge push for trade schools. And that's a long play. I think that doesn't fix the problem for at least a decade. And in my opinion, I know this can be controversial, but the short-term fix is some form of immigration program tied with a work-type program where if you can get vetted and in the country legally on a work program to go and work for American businesses that provide skilled laborers and make that work so that it's fair for everybody. And I think it can be, I believe it can be done in a way that is safe, legal, efficient, and also doesn't hinder the workforce here in the United States. Unemployment is low, and I believe that there are plenty of jobs that immigrant labor wants to come in and take the opportunity of the American dream. I truly believe it can be done. We've just got to get politicians to get to the table and not have it be a political issue anymore, but actually work on how do we make this safe and legal and productive for U.S. workforce. The U.S. labor force is getting older, and that's exacerbated in the skilled trades because it's hard work. And so we need to get young kids, I would say Gen Z and Gen Alpha. I think the millennial generation is kind of past that. They're really entrenched in college, in my opinion. But get Gen Z and Gen Alpha really focused on trades being a great opportunity for a long-term career for them. And then a backfill, we can do an immigration type program that is efficient and makes sense. And don't want to make, like I said, don't want to go too political, but if anybody can do it, it's Elon. I truly believe that, because for crying out loud, the guy's company caught the booster rocket big heavy, like he was picking up a piece of sushi with chopsticks. And I think it can be done as a stopgap measure to help fill that void that we have in terms of that labor deficit, because by all accounts, there are estimates of anywhere from 2.5 to 7 million unit housing shortage. You do the math, what I just said, like 1.5 million. When we get to 1.8, the system starts to crack. So that 300,000, the system is cracking. But even doing that to make up 2.5 million is essentially, we're talking, basically eight plus years. And so we really need to focus on how do we beef up the capacity right now. The other big problem that we have, in my opinion, as it relates to supply, and this ties into the land costs, the labor costs, and deals penciling, is the regulatory fees. There's a lot of liability that builders take on, both financially for the long term, to go through cycles to build, a community from dirt all the way to finished homes, and it has to make a certain amount of money. It's just, this is economics as well too. I just read an article by the NHB as well. They had a 2021 study that estimated that a typical home in the United States, new home, has over $90,000 in fees associated with it. So, I mean, if you take $90,000 in regulatory fees and the time and the pain and the that it puts on getting projects approved, bringing them to market, what it does to the builder's ROI. You put that with rising labor costs and the capacity issues for the skilled labor that we need to build these houses. Then put that on top of just the overall market dynamics that are pushing land costs up. And you have a recipe for a continued undersupply for the next 4, 5, 6 years. And go back to supply demand. If you have inherent demand and you're undersupplied, that is going to keep prices high. And that's just going to push the whole system. So in my opinion, the major driver of inflationary problems with housing is the undersupply with the inherent demand. So we need to get the supply up. We need to get the regulation out of the way so we can also help get the supply up. And the regulation adds to a lot of these costs, but it also adds to a difficulty in getting these communities to market. And so we've got to fix those fundamental things, in my opinion. It's the capacity of the trades to be able to build the homes, get rid of the regulations or limit the regulations, eliminate some of them so we can bring these projects to market quicker with less regulations, less fees, so that we can boost up the supply. If we do that, we can hope at best, in my opinion, to stabilize pricing, which I think would be good to have a nice like stability. And then maybe, just maybe, and I know there's talk politically about privatizing all of the mortgage like the Fannie and Freddie, but I've been an advocate, I've talked to people about this. I'm a big advocate of a government-backed program for mortgages at a fixed rate, put a tier program together with like a matrix. You have this much down, you have a credit score of this, you automatically qualify for a rate of this. Move that matrix around and let's stabilize interest rates over the long haul, because what we find, just like in politics, we don't like elections because we don't like what's going to come, the not knowing what's going to come. Once everything is done and it's over, we go back to business as usual. I think that's the same thing for interest rates. If we can stabilize interest rates over the long term, you take that piece out of the equation, and then that doesn't become a thing that actually increases demand or decreases demand. Then the inherent demand starts to be a little bit more consistent with, do people need to move? Do they need housing for growing families or for changing jobs, et cetera, et cetera. So, hey, that's what I got. A little bit longer today. Hope you were still able to finish listening to this on your commute, and hopefully you click the link when we put it out for the earnings report summary. As always, please, we'd appreciate if you like this episode, share it with somebody, subscribe, and hit the notification bell so that when new episodes come out, you get the ding and and you can listen to more of the Builder's Mindset podcast. And we really appreciate you showing up and listening, and hope that we will get to see you, hear you, or you'll hear us on our next episode. And if you have any ideas or suggestions, feel free to let us know. You can reach out to us on LinkedIn or put a comment in the channel. Topics you'd like us to talk about, like us to research. We're always looking for things to look into deeper, and we love your ideas and your thoughts. So with that, have a great day, and I hope you enjoy the earnings report summary and market assessment. Talk to you soon. Thanks for listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Remember, your mindset matters,